Hi everyone, thanks for tuning into my channel, All Things Accounting. Today, what we're going to be going through are journal entries. We'll go through a numerical example and I'll show you how they work. Okay, so stay tuned and we'll get through this together. So journal entries, before we begin, let's just define certain things so that we understand it a little better. So journal entries are recorded in what is called the general journal. Okay. Now, the general journal and journal entries all have the following information. They would have the date of the transaction. I'll denote transaction as TX for short. They also have they'll also list the different types of accounts that are affected. So the titles of affected accounts. Okay. They will also have the dollar value of the transaction. And lastly, they will have an accompanying explanation so that later on down the line, when you look back, well, okay, I spent money to buy something, to buy equipment, or for whatever purpose. What was it for? Okay, so these are certain things that you can always keep in mind. So remember, just again, double entry accounting. That was where we do journaling of transactions where it hits at least two entry accounts. Okay, so that way it helps us to ensure that we're always balancing out. Okay, now if we look at a journal entry where it affects three or more, then what we call that is a compound journal entry. Okay, so let's go through some examples. All right. Okay, so let's say, for demonstration purposes, that our friend Carol starts a business, a cutlery business. So let's say on August 1st, she invests about $3,000 cash into a checking account in the name of her business, and she also invested $15,000 of equipment that she already owns. So because she's invested cash, so we would account that by debits. She also, and that was in the amount of $3,000. She also invested $15,000 in equipment. Okay, so $15,000 there. So the offsetting, those would be debits. The offsetting would be Carol capital. So remember, in this type of accounting, we want to make sure that we're always balanced. So here it would be $18,000. Okay, and then you would have the explanation. Okay, now let's say that also on August 1st, that our friend Carol paid $600 for 6 months of insurance. So because it's 6 months of insurance and she hasn't used it yet, that would be an asset, prepaid insurance. Okay, and that would be $600 worth, and she paid it using cash. So $600 there, 600 again. double entry accounting, it's balanced. Up here is a compound journal entry where it's 3 or more. Okay? Let's say on August 2nd, what our friend Carol did was that she paid $600 for furniture for the shop. Okay, so let's assume that she paid that using cash. So it would be debit, furniture, credit, cash. So crediting an asset account like cash, it's reducing it, right? 600. Let's just say that on August 17, she had to pay her employee. She has one employee. So in this case, it would be debit wages expense, because remember that expenses are increased by debits, and let's say that she paid that using cash here. So let's say that she paid her employee $800. Okay, let's continue on, and let's say that on August 18, let's say for her business, she received cash. Okay, she received cash in advance for future services that will be rendered. Okay, so it would be debit cash, in this case, increases. Let's just say it was for $1,000. And here it would be unearned revenue for whatever the service is there. Remember, in all these cases, I'm just leaving for space sakes, I'm leaving out the explanation, but there will always be an explanation underneath. All right. Now, let's say on August 19 that she had a hydro expense, a utility expense, and so she's paying that on account, not using cash. So in this case, as it's an expense, we can say hydro expense. Okay, and let's just say that that's $1,200. And credit, if she's paying on account, that would be a liability, so we could say it's accounts payable. Always keeping in check that under double entry accounting, it's always balanced. And as a last example, let's just say on August 20, she decided to withdraw some amount from the business. Okay, so in this case, she would say, Carol, withdraw. And crediting cash, which reduces the cash balance, or let's say $500 that she would decide to withdraw. Okay, and also note that the withdrawal under the owner's equity section, that anything that's debited would be working to reduce the balance of the owner's equity account. Okay, so all of these, again, these are simple journal entries. The next step would then to be posting these journal entries to their respective accounts, and that's where T accounts would come in very handy as well. So these are just some basic accounts so that you see how assets, liabilities, equity, revenue, and expenses are affected. Okay, so I hope you enjoy this little tutorial. Hope you subscribe and click that bell notification icon for future tutorials that I'll be posting. And until next time, take care.